Welcome again, dear students and scholars. In this video, we begin ASC 280 segment reporting. This topic is about helping users see inside a diversified business. A consolidated financial statement gives one total revenue number and one total profit number. But a real company may have very different product lines, regions, customers, and risks behind those totals. ASC 280 tells public entities how to report segment information so users can understand the business the way management actually reviews it. Segment reporting exists because consolidated totals can hide business reality. Imagine a company with one strong consumer division, one declining legacy division, and one international operation facing currency and regulatory risks. If users only see total revenue and total net income, they cannot judge where the growth is coming from or where risk is concentrated. Segment disclosure releases that hidden information. It does not replace the consolidated statements, it adds decision useful detail behind them. The scope of ASC 280 is mainly public entities. Public companies and other public business entities must provide segment disclosures when the guidance applies. Non-public entities are not required to follow ASC 280, although they may choose to provide segment-style information voluntarily if it helps lenders, investors, or other users. Also remember the interim angle. Public entities issuing interim financial statements to shareholders may need segment information consistent with the annual presentation. So before applying the rules, always check scope first. The hidden data problem becomes clearer when you think about one parent company with several internal stories. Product lines may carry different margins. Regions may face different economic and currency risks. Customer groups may behave differently, and subsidiaries may operate under different legal or regulatory environments. ASC 280 is designed to prevent those differences from being buried inside one aggregated number. The standard is basically saying if management sees meaningful internal parts, users may need to see them too. The management approach is the heart of ASC 280. Segment reporting follows how management actually organizes and reviews the business internally. The standard does not force every company into the same product, geography, or legal entity template. Instead, it looks at the internal reports reviewed by the Chief Operating Decision Maker or CODM. That is why two companies in the same industry may report different segment structures. The goal is to show the business through management's own decision making lens. The chief operating decision maker is identified by function, not by job title. It may be the chief executive officer, the chief operating officer, an executive committee, or another group that actually allocates resources and assesses performance. Do not search only for a title on the organization chart. Ask who receives segment level information, who evaluates the segments, and who makes resource allocation decisions. In ASC 280, what the person or group does matters more than what the business card says. An operating segment must meet three conditions. First, it engages in business activities from which it may earn revenues and incur expenses, including transactions with other parts of the same entity. Second, its operating results are regularly reviewed by the CODM to allocate resources and assess performance. Third, discrete financial information is available. All three conditions must be present. A department may be important, but importance alone does not make it an operating segment. The segment manager role helps us understand accountability, but it is not a separate fourth test. Many operating segments have someone responsible for budgets, forecasts, operating plans, activities, and financial results. That person is accountable to the CODM. The existence of a segment manager can support the analysis of how the business is organized, but we still return to the operating segment criteria: business activity, CODM review, and discrete financial information. Not every internal activity qualifies as an operating segment. A business unit that earns revenue, incurs expenses, has discrete financial information, and is reviewed by the CODM may qualify. But corporate headquarters, human resources, information technology support, finance support, pension plans, and general administrative functions usually do not qualify merely because they appear in internal reports. Segment reporting is about operating components, not every cost center inside the organization. Segments may be organized in different ways because the standard follows management structure. One company may manage by product lines such as hardware, software, and services. Another may manage by geography such as domestic, Europe, and Asia. Another may manage through legal entities or customer channels such as enterprise, government, and retail. The correct structure is not the one that looks neatest on paper. The correct structure is the one that reflects how management actually reviews performance and allocates resources. Now, separate two ideas: operating segment and reportable segment. First, we identify operating segments using the three criteria. Then we decide which of those operating segments must be separately reported. That second step uses quantitative significance tests, including revenue, profit or loss, and asset thresholds. So, an operating segment is not automatically a reportable segment. Video 2 will handle that filter in detail. Entity-wide disclosures are a separate layer. Even when a company has only one reportable segment, ASC 280 may still require information about products and services, geographic areas, and major customers. Geographic disclosures include revenue information and long-lived assets by location. Major customer disclosure applies when a single customer accounts for 10% or more of total revenue. These disclosures help users understand business mix, geographic exposure, and customer concentration beyond the segment structure itself. Here are the common concept traps. First, do not assume the CODM is always the Chief Executive Officer. Second, do not define segments based only on legal entities, tax structures, or investor relations categories if internal management reports tell a different story. Third, do not treat support departments as automatic operating segments. Fourth, do not confuse operating segments with reportable segments. ASC 280 is a sequence. Identify the operating segments first, then apply the reportable segment tests. Before we close, remember the 6 anchors from video 1. A SC 280 applies mainly to public entities. It uses the management approach. The CODM is defined by resource allocation and performance assessment functions. Operating segments require business activity, CODM review, and discrete financial information. Internal reporting drives segment boundaries. Then, reportable segment tests determine which operating segments must be separately disclosed. In video 2, we will cover the 10% revenue, profit or loss and asset tests, the 75% external revenue test, aggregation, and a full segment testing illustration. Please like this video, share it with your colleagues, subscribe to Commerce Regiment, and support the channel so we can keep building structured US GAAP education.